Welcome to the deep dive. Today, we're tackling a huge name, John D. Rockefeller Sr. We all think of, immense wealth, Standard Oil.
The empire, yeah.
Exactly. But we're zeroing in on something else, his financial intelligence, the skills that actually built it all.
Right, the engine behind the machine, not just the machine itself.
Precisely. So we're going to walk through 7 key stages of his career, almost like a financial biography.
And at each stage, we'll look for the signs. What showed his financial literacy? What were the actual benefits?
And crucially, what are the takeaways for anyone listening, whether you're running a business or just managing your own finances?
Yeah, what's fascinating is how these principles build on each other. It starts small, very fundamental, and then gets, well, increasingly complex as he grows.
Okay, so let's dive into stage 1, the groundwork. We're in Cleveland. Rockefeller's just 16, first job, assistant bookkeeper.
Hewitt and Tuttle, a produce firm. Seems pretty humble, right?
A world away from oil. But this is where those first seeds were planted.
Absolutely, and you can see the signs already. First off, he was meticulous, not just doing his job, but really into the details, the methods and systems, as he put it. He tracked everything.
Everything, like income, expenses.
Income, expenses, and even his charitable giving, right from that first paycheck. That's sign number 1.
Right.
Second sign, discipline. Saving and giving from the get-go.
Yeah.
He started giving 6% to charity.
6% from his first, likely tiny salary.
Yep, and by the time he was 20, he was over 10%. That shows a real grasp of managing money, even when you don't have much.
Wow. Okay, and the third sign?
Just the job itself. Being a bookkeeper taught him the basics, costs, accounts, how money actually flows in a business. Real practical stuff.
So those early habits, they must have given him some real advantages down the line.
Oh, definitely. Benefit 1, he started building capital. Saving consistently, tracking diligently, that created a foundation. Money he could use later.
Makes sense.
Benefit 2, that love for systems. It bred a methodical approach. Crucial when things got bigger and more complicated.
And the third benefit?
Financial discipline. That habit of saving and giving wasn't just about the money itself. It built the muscle of managing wealth responsibly. Super important later on.
So if someone's just starting out today, what's the lesson from 16-year-old Rockefeller?
3 big ones, I think. First, master the basics.
Yep.
Bookkeeping, understanding cash flow. Don't skip that. It's fundamental.
Right.
Second, start saving and tracking now. Consistency builds that foundation no matter how small you start.
Okay.
And third, discipline pays off. Even with a little income, those good habits add up significantly over time. It really does work.
Okay, let's jump ahead. 1859, Rockefeller's 20 now. He's stepping out, launching his first actual business.
Yeah, the produce commission firm Clark, Gardner & Company. Moving from employee to entrepreneur. Big step.
So how does his financial literacy show up here in this new role?
Well, first sign, leverage. He'd saved $800 himself, which was decent.
Yeah?
But the business needed more capital, $4,000 total. His share was $1,800, so he borrowed $1,000 from his father.
Interesting. Borrowing already.
Exactly. At 10% interest, mind you.
Right.
He understood using other people's money, taking a calculated risk to make a bigger play. That's a key sign.
Okay, leverage. What else?
Second sign, spotting opportunity. The Civil War breaks out. Huge demand for supplies from the Union Army. They saw that need and jumped on it. Market awareness translating to profit.
Smart.
And third, they were consistently profitable. The business made money every single year. That points to sound management, not just luck.
So what were the immediate payoffs of these skills in that first venture?
Well, first, the borrowing allowed him to actually launch the business. He wouldn't have had enough capital otherwise. Leverage opened the door.
Right.
Second, jumping on that wartime demand. That accelerated the growth massively, big profits early on.
Gotcha.
And third, being consistently profitable built a track record. It gave him confidence, credibility, and importantly, cash to reinvest.
So for entrepreneurs listening now, what are the lessons from this stage?
1, don't be afraid of calculated risk, including borrowing. Smart debt can fuel growth. 2, keep your eyes peeled for market shifts. Be ready to adapt and meet new demands. That's where opportunities often lie.
Makes sense.
And 3, focus on profitability from day 1. It's a core engine of any sustainable business. Aim for consistent performance.
All right, now things really start heating up. Oil is discovered also around 1859, and Cleveland starts becoming this refining hub.
Yeah, the whole landscape changes. And by 1863, Rockefeller and his partners are in the game, opening their own refinery.
But the really pivotal moment comes in 1865, doesn't it?
Oh, yeah. He buys out the Clark brothers, pays $72,500, which was a fortune then,
72 grand.
for control of what was then the largest refinery in Cleveland. He called it the day that determined my career.
So what financial skills are on display here?
Okay, sign number one, strategic investment. He saw that refining was the bottleneck, the crucial point in the oil value chain, and he invested heavily there.
Positioning.
Exactly. Sign two, recognizing value and seizing control. Paying that premium, the $72,500, showed he understood the strategic value of control. He wasn't just a partner anymore.
He wanted the reins.
Precisely.
Yeah.
And sign three, that relentless focus on efficiency. Even then, others were discarding like 40% of the crude oil as waste.
Really?
Yeah. He was already figuring out how to use those byproducts. Plus, cutting costs everywhere, building his own barrels, hiring his own plumbers, thinking about every penny.
That efficiency piece seems huge. What were the immediate benefits?
Well, first, buying out the Clarks gave him control. He could implement his vision, his strategies, without needing consensus.
Oh, control.
Second, that focus on efficiency and using byproducts. Direct impact on the bottom line. Higher profits, lower costs than competitors.
Competitive advantage.
Big time. And third, having the largest refinery plus that efficiency mindset. It perfectly positioned him for the massive expansion that was coming.
Lessons for entrepreneurs here. Seems like a big turning point.
Definitely. First lesson, invest strategically in your core operations. Where can you gain a real competitive edge? Focus there.
Okay.
Second, ruthless cost cutting. It's not glamorous, but finding efficiencies unlocks serious value. Look everywhere.
Don't overlook the small stuff.
Never. And third lesson, sometimes you have to pay a premium for control. Making that bold move, like Rockefeller buying out his partners, can be necessary for long-term strategy.
Okay, next stage. The partnership evolves again. 1870, they formed the Standard Oil Company of Ohio, a corporation.
Yes, and this is a fundamental shift. It's about scaling up, big time.
How did his financial thinking drive this?
Sign one, structuring for growth. Forming a corporation made it way easier to raise serious capital by selling stock. It also facilitated expansion. It was a vehicle built for getting bigger.
Right, more formal structure.
Sign two, attracting talent. He brought in Henry Flagler. Flagler was brilliant at organization, logistics, the business side. He complemented Rockefeller's money skills perfectly.
Recognizing he needed help.
Exactly. Building a team, that's financial leadership too. And sign three, strategic capital allocation. They borrowed heavily and plowed basically all their profits back into the business. Super aggressive reinvestment.
Not taking profits out, but fueling more growth.
Relentlessly. Using debt and profits to expand rapidly.
And the benefits of incorporating in these strategies.
Huge benefits. One, access to much more capital through the corporate structure that funded the expansion.
Okay.
Two, bringing in Flagler boosted their organizational capacity. They could manage the growing complexity.
Doing the machine run better.
You got it. And three, that aggressive reinvestment allowed them to just outpace everyone. They could seize opportunities faster.
Lessons from this corporate stage for founders today.
First, pick the right legal structure. Think about how it impacts funding, scaling, liability. It matters. Second, build a strong team, especially on the financial side. Find people who complement your skills. Don't try to do it all.
Good advice.
And third, especially early on, reinvest profits strategically. That's how you get exponential growth. Delay gratification for future scale.
Okay, so Standard Oil is formed, capitalized, and growing. By the early 1880s, they achieve, well, near total domination.
Yeah, something like 90% of U.S. refining and pipelines.
Yeah.
It's staggering. And it's built on very deliberate financial strategies.
What were the key moves? What signs of financial mastery do we see here?
Okay, sign one. Horizontal integration. They systematically bought up competitors, other refineries.
Just swallow them whole.
Often, yeah.
Yeah.
But smartly, using cash, stock, and sometimes even bringing the best executives from the acquired companies into Standard Oil. It wasn't just about killing competition, it was consolidating power and talent.
Clever.
Sign two, vertical integration. This was huge. They didn't just refine oil. They bought or built pipelines, railroad tank cars, delivery networks. They control the whole process.
From well to lamp, almost.
Pretty much.
Yeah.
That gave them incredible control over costs. And sign three, strategic pricing. They generally kept prices low.
Low. You'd think a monopoly would raise prices.
They did sometimes, but the general strategy was affordability. It grew the market and made it incredibly hard for anyone new to compete. They'd even sell below cost temporarily in some areas to drive out rivals.
Wow, using price as a weapon.
Absolutely. Very powerful financial tool.
And the benefits of all this integration and pricing strategy. Pretty obvious, I guess.
Yeah. Benefit one, near monopoly control, massive market power. Benefit 2, huge efficiencies. Controlling the value chain slashed their costs way below anyone else. And benefit 3, immense personal wealth for Rockefeller and the shareholders. This is where the legendary fortune really exploded.
So looking at this dominance phase, what should today's business leaders think about?
1, strategic acquisitions can be a powerful path to market leadership. It's not just organic growth. Consolidation can be key.
Okay.
2, really analyze your value chain. Can integrating vertically upstream or downstream cut costs or give you more control? It's often worth investigating.
I see.
And 3, understand pricing isn't just about profit margins. It's a strategic lever for market share, competition, and growth. Use it wisely.
But that dominance eventually led to problems, right? The next stage involves backlash.
Yeah, the tide turned. Accusations of unethical practices, anti-competitive behavior. It all culminated in the 1911 Supreme Court decision.
The big breakup. Standard Oil ordered to dissolve into 34 separate companies.
Exactly. The end of the empire as he built it.
Yeah.
But here's the kicker. Rockefeller's personal wealth kept growing.
How? How does that happen after your company is dismantled?
Financial literacy, again, just applied differently. Sign 1, diversified ownership. He didn't lose everything. He simply ended up owning large chunks of those 34 new companies. Companies that became giants like Exxon, Mobil, Chevron.
Ah, so his assets just changed form.
Precisely. He remained the largest shareholder in many of them. Sign 2, shifting focus. He already stepped back from day-to-day operations around 1897. So his job now became managing this vast portfolio of stocks, wealth preservation, and growth.
A different skill set.
Absolutely. And sign 3, the most telling one, the breakup actually unlocked more value. As separate competing entities, the sum of the parts became worth more than the whole had been under the trust structure. That's what pushed him over the edge to become the first billionaire.
Incredible. The breakup made him richer.
Ironically, yes.
So, benefits of his approach during this turbulent time.
1, he preserved his wealth. Diversification saved him from losing it all when Standard Oil was broken up. 2, he still held significant financial influence through those distributed shareholdings.
Still a major player.
Definitely. And 3, stepping back from running the business freed him up, gave him time and resources for other things.
Which leads us nicely to the lessons here, especially if you face disruption or major change.
Yeah, lesson 1, diversification. Diversification, diversification. Cannot stress it enough for protecting wealth. Don't put all your eggs in one basket.
Right.
Lesson 2, think long-term about wealth preservation from the start. Structure things, anticipating potential changes down the road.
Plan for the unexpected.
Kinda, yeah. And lesson 3, financial success buys freedom. The freedom to shift focus, pursue new interests, maybe even redefine your legacy.
And for Rockefeller, that led directly to the final stage we're looking at, philanthropy.
Yes, his retirement project, you could say.
Yeah.
But he approached it with the same strategic rigor as his business.
How so? What are the signs of financial thinking applied to giving?
Sign 1, organization. He moved away from just random donations, what he called haphazard, toward a structured, business-like approach, creating foundations, setting clear goals.
Treating charity like a business.
In terms of process, yes. Sign 2, focus on root causes. He wasn't just interested in temporary relief. He wanted to cure evils at their source. Big systemic change through large, targeted donations.
Aiming for leverage again, in a way.
A different kind of leverage, exactly. Impact leverage. And sign 3, long-term investment in impactful areas. Education, public health, science. Founding the University of Chicago, Rockefeller University. These were built to last and generate returns for society. He even called the University of Chicago his best investment.
His best investment, huh? Interesting. And the benefits of this strategic philanthropy?
Immense. Benefit 1, massive social impact. His funding led to breakthroughs in medicine like fighting hookworm and yellow fever and transformed higher education. Real, tangible good.
Lasting effects.
Absolutely. Benefit 2, enduring institutions. Those universities and research centers are still world-class, still making discoveries.
Okay.
And benefit 3, a powerful legacy. He set a new standard for large-scale strategic philanthropy that many have followed since. It reshaped how the wealthy thought about giving back.
So the final lesson from Rockefeller, looking at this philanthropic stage.
I'd say 1, apply business principles to your giving if you want maximum impact. Strategy, focus, measuring results. It works for philanthropy too.
Don't just write checks.
Right. Give smartly. 2, focus your resources. Decide where you can make the biggest difference and concentrate your efforts there for greater effect.
Okay.
And 3, Philanthropy can be an incredibly powerful final act. It can complement a business career and create a different, perhaps even more lasting kind of legacy.
Wow. Quite a journey from a 16-year-old bookkeeper meticulously tracking pennies.
To a billionaire strategically investing fortunes to reshape education and medicine. It really is a masterclass in financial literacy applied at every scale.
And the core idea is understanding costs, managing capital, strategic investment, discipline. They seem relevant no matter what you're doing.
Absolutely timeless principles.
So maybe the thought to leave everyone with is this. How can you take these principles, this idea of financial literacy, and apply them consciously, not just to your bank account or your business?
But maybe even to how you think about making your own impact on the world, whatever form that takes.
Exactly. Lots to think about. Thanks for joining us for this deep dive. Welcome to the deep dive. Today, we're tackling a huge name, John D. Rockefeller Sr. We all think of, immense wealth, Standard Oil.
The empire, yeah.
Exactly. But we're zeroing in on something else, his financial intelligence, the skills that actually built it all.
Right, the engine behind the machine, not just the machine itself.
Precisely. So we're going to walk through 7 key stages of his career, almost like a financial biography.
And at each stage, we'll look for the signs. What showed his financial literacy? What were the actual benefits?
And crucially, what are the takeaways for anyone listening, whether you're running a business or just managing your own finances?
Yeah, what's fascinating is how these principles build on each other. It starts small, very fundamental, and then gets, well, increasingly complex as he grows.
Okay, so let's dive into stage 1, the groundwork. We're in Cleveland. Rockefeller's just 16, first job, assistant bookkeeper.
Hewitt and Tuttle, a produce firm. Seems pretty humble, right?
A world away from oil. But this is where those first seeds were planted.
Absolutely, and you can see the signs already. First off, he was meticulous, not just doing his job, but really into the details, the methods and systems, as he put it. He tracked everything.
Everything, like income, expenses.
Income, expenses, and even his charitable giving. Right from that first paycheck. That's sign number 1.
Right.
Second sign, discipline. Saving and giving from the get-go.
Yeah.
He started giving 6% to charity.
6% from his first, likely tiny salary.
Yep, and by the time he was 20, he was over 10%. That shows a real grasp of managing money, even when you don't have much.
Wow. Okay, and the third sign?
Just the job itself. Being a bookkeeper taught him the basics